welcome to this session today where I'll be pointing the spotlight of focus on our fairly recently launched specialist first charge resi side here at West One. My name is Steve Manakey and I'm National Account Manager, and we start where the credit scoring lenders stop. What I'd like to go through during the session this morning is I'll give you a quick introduction to West One and Enra Specialist Finance we're part of, because of course when you're recommending specialist lenders, particularly those of us that are fairly new entrants into the resi specialist space, very often your clients will ask, who's that? So I'll just give you some facts about our journey as an organisation over the last sort of 20 years so that you can impart those facts to your customer so that they know who it is that they're taking their mortgage from. I'll also talk about the rise of specialist lending over the last sort of 14, 15 years, the economics events that have driven that, and effectively how specialist lending has become the new mainstream. And I'm still fairly new to West One. I've been here for nearly 10 months, but what I've managed to do in that time is segment what we do in the first charge specialist resi space down into three main specialisms of lending. I've christened them our three pillars of lending. I'll talk about them in popularity order. The first and the third specialism are similar to what lenders that we compare ourselves against do. So you would talk about us in the same breath as lenders like Aldermore, Vida, Pepper Money, TML, Kent Reliance, Kensington, Bluestone. Obviously, we do this stuff better. And our second specialism is the one that I think makes us really, really unique in the specialist space. The session will last about 45 minutes, and you can ask any questions in the Q&A tab, and we'll pick up those at the end of the session. So without further ado, who are West One? Well, West One are part of Enra Specialist Finance. Enra has been around for 22, 23 years. West One as a lending proposition was launched in 2005. We were originally launched as a short-term lender, so bridging and development finance. Nobody in the UK does more bridging than us apart from Together, and we are now the largest and fastest growing non-bank lender in the UK. In the years in between, we've launched into the seconds market, specialist buy-to-let, about 5 years ago, and we in the first charge specialist resi arm are just over a year old. We became part of the Elliott's investment group in the US in the latter part of 2022, which is brilliant from lots of different perspectives. Elliott's are one of the largest, longest established private equity firms in the world. They've been around for 50 years. Amongst other things, they manage and own the largest activist hedge fund in the world. And if you're a football fan, they own AC Milan, and they were one of the bidders for Man United early last year. So lots of strength in the background with the involvement of Elliott's. And from a mortgage lending perspective, one of the benefits of the involvement with Elliott's is they give us access to retail funds. So you'll see us sourcing way better than we ever have done. In the specialist first charge resi side here at West One, our products, pricing wise, start with a 5, which is pretty good. And what you can have, for example, on your credit file to qualify for rates that start with a 5 will become clear in a little bit. So that's just a bit of a potted history about our journey as an organisation over the last sort of 20 years. So what is it we do? Well, the reason that we launched into the specialist resi space, if we're old enough, as I am, to remember when there was a real polarisation between what was the old kind of subprime lenders, as they used to be, the original Kensington, GE Money, I Group, those sort of lenders, and the high street lenders. There was a massive polarisation between those two camps. The majority of people fell into the high street world as borrowers, and the unlucky few fell into subprime. There's been a few events of note over the last sort of 14, 15 years. The worldwide financial crisis of sort of 2007 through to 2011, 2012, the pandemic, the cost of living crisis that seems to be ongoing. And it's meant that the negative byproducts from those events have meant that more customers than ever have needed specialist mortgage finance as opposed to being able to go to the high street. Levels of defaults of CCJs and missed and late payments on unsecured credit are at a higher level than they've been for a number of years, meaning that more borrowers than ever need to go to specialist lenders because they're precluded from the high street. It's meant that credit risk parameters and lending criteria has become tighter than ever, as has affordability and LTIs and equivalent multiples. Underserved borrowers, such as older borrowers and those with adverse credit, as I've mentioned, and also the self-employed, need alternatives to those traditional high street lenders that they've been able to go to before. And we've had a real kind of uptick in other economic problems like the cost of living crisis, a rising interest rate environment that's meant that, you know, people have relied on unsecured debt more than they ever have. And because of the interest rates that have been increasing fairly consistently over the last sort of 2 or 3 years, it's meant that that mountain of debt has become kind of harder and is becoming harder to service for people. So specialist finance is very much part of everybody's talking point now. When it used to be a fairly rare thing for a mortgage broker to talk about specialist mortgage lending, it is part of their daily conversations. And that's why we launched ourselves as another lender option in first charge specialist resi. I've talked about those 3 pillars of lending. And the first one, the first specialism that we have is anything credit related. That's the title I've given it. And it's the lending that we do that is inextricably linked to being a true non-credit scoring lender. So there's no credit score. There's no algorithm, no scorecard that sits in the background. We use Equifax only, and it's a soft footprint at dip stage. With ourselves, there are 3 metrics, 3 main metrics going on in our lending decision, which is what you as the broker tells us at decision in principle stage, what we find on Equifax, and a mandated underwriter. That's it. So we manage and process our business manually. All of our underwriters are based at head office. There's no hybrid or remote workers as far as underwriters are concerned now, which is a brilliant and an ideal situation, because it means that underwriters are bouncing ideas off of each other and they're not working in this silo-based existence that they are with other lenders. They're all based at our head office, interacting in the good old-fashioned way. We are one of the very few lenders in the specialist space that offers true dedicated case management. So you have a single contactable case owner that's looking after your case throughout the processing journey from submission through to offer. And that gives you continuity and consistency around 2 really important things. It gives you continuity and consistency around what it is as a lender that we're asking for to get that case to offer. And we're also giving you continuity and consistency around who it is that's asking for that stuff. So it's a one set of eyes approach to processing your customer's mortgage, and it's worth its weight in gold. And those ladies and gents can be contactable in 2 ways: throughout the processing lifespan of the case on the phone, or via the interactive message sending service on the case. Everybody loves that. Everybody loves it. So when you're faced with a true non-credit scoring lender, you're probably forgiven for jumping to the adverse lender conclusion. Why else wouldn't you credit score as a lender, unless it's to help people that fail credit score, and people fail credit score because of adverse credit. It's that natural kind of stepping stone set of assumptions that you make. Our definition of true adverse is probably the same as yours, which is one of 3 specific things, which is CCJs, defaults, and mortgage arrears. So unless I tell you in its broadest sense all the reasons why we don't credit score as a lender, you'll just walk away from this session thinking that West One are the lender that you can come to because we don't credit score when you've got a customer that's failing credit score because of CCJs, defaults, and mortgage arrears. And of course, you can do that. But what's really, really vital for me to explain, and the way I sum it up with brokers, is I say that the reason that we don't credit score is because it gives us the ability to lend to customers that are failing credit score or will fail credit score because of pretty much any wider credit profile related reason, as well as CCJs, defaults, and mortgage arrears, as opposed to just because of CCJs, defaults, and mortgage arrears. As you know, the reason why people fail credit score go a lot broader and deeper. You can have first-time buyers that are failing credit score because of a sheer lack of credit activity. A sheer lack of credit activity will very often generate a credit score decline. At the polar opposite end of the scale, you've got people with the polar opposite problem. They've got a very prominent footprint on Equifax, lots of active credit, well maintained, but the debt to income ratio maximums that are factored into the scorecard with credit scoring lenders is determining that your customer is over indebted. They're servicing that debt well, but there's too much of a similarity between the customer's level of debt and their level of income, and they're therefore failing those dreaded preset debt to income ratios. We can help you with those because as a non-credit scoring lender, we don't have any maximum debt to income ratios we don't have a scorecard to factor it into. So for us, affordability is the one true factor that we look at in those situations. We go to 90%. So whatever loan you want from us in tandem with the credit that you're maintaining in the background, as long as it works on our affordability model, we will lend, irrespective of what sort of similarities might exist between the customer's income and the level of debt that they own. So those are the two polar extremes. And in the dead center ground between those two polar extremes is maybe a different type of customer again. This type of customer maybe has no issues with debt to income ratios. They've got the right amount of debt in relation to their income. The problem for them and the thing that's driving a credit score decline is that they're just not particularly good at paying back their unsecured fixed term and revolving credit on a monthly basis. And they've got a little bit of a checkered history of paying that stuff back on time, and their credit file replicates that. And as much as it looks a bit like a Dulux color chart, it's got oranges and yellows and reds and greens dotted about all over it. And we will give you lots of flexibility around helping people that have got a bit of a hit and miss history of paying their unsecured credit back on time every month. And when you're in that situation and things start to get a little bit worse for you and you start to default on stuff, you start to pick up county court judgments and secured or mortgage arrears, and you're then falling into traditional adverse credit territory, we can lend to you there as well. So the reason we don't credit score goes way beyond just being able to help people that have got CCJs, defaults and mortgage arrears. What we want to be is that kind of plan A choice of lender when you as a broker need to plan B because you've got a customer that's failing credit score because of pretty much any wider credit profile related reason. And I'm more than happy to review credit files for you. If you want to send me a credit file, I'm more than happy to have a look at it to tell you firstly whether we can lend, and secondly which of our product tiers your customer qualifies for. So yeah, anything credit profile related. And to give you a bit of a flavor as to how flexible we are and what a big appetite we've got, on everything apart from our higher LTV products, we completely ignore satisfied CCJs and defaults. Doesn't matter how many you've got, what the pounds value is, either singularly or cumulatively, doesn't matter when they were registered. If they're satisfied, we'll ignore them from the perspective of what product your customer qualifies for. We'll also completely ignore unsatisfied CCJs and defaults that are for no more than £500 each. Again, no limit to when they were registered or the number of them. If they're for no more than £500 and unsatisfied, we will ignore those too. We'll also ignore comms and utilities accounts, whether we're talking just poorly paid in terms of like on time every month, or those that are physically defaulted. If we can see that they're utilities or comms orientated, they get ignored as well. And that's on all of our products, even the higher LTV stuff. So it's only really unsatisfied CCJs and defaults for more than £500 each that we worry about, because on the majority of our products, we pretty much ignore everything else. And they need to be registered just 2 years ago to qualify for our best products. So you can have effectively an unlimited number of unsatisfied CCJs and defaults that are for more than £500 each. They need to be registered just 2 years ago to qualify for products that start with a 5. So pretty good, pretty good. With mortgage arrears, your customer's mortgage arrears need to be registered just 12 months ago to qualify for our best products. With many lenders in the specialist space, if you've got mortgage arrears registered 12 months ago, your customer will qualify for one of their worst product tiers. With ourselves, you'll qualify for one of our best product tiers, which is a massive difference. And with mortgage arrears in mind, one thing that we're brilliant with are those classic late but not missed mortgage payment scenarios. What I mean by that is it's linked to our sort of more flexible definition of what constitutes mortgage arrears. With the vast majority of mortgage lenders, if you don't pay your mortgage payment on the day of the month that you've agreed to, they'll register a status 1 on your credit file. Even if you've paid that mortgage payment the following day, they'll register a status 1 on your mortgage account. Our definition of mortgage arrears is a mortgage payment that wasn't made by the due date of the following month's payment. So we'll give you that 30 days kind of flexibility. So if your customer's got a status 1 on their mortgage account and it's causing you absolute murders, it's either making you plummet from what feels like a really good tier with a particular credit specialist lender down to a much worse one, or worse still, if it's registered within the last 12 months, which most lenders don't like, and it's precluding lending completely, come and talk to us. Because if you can prove that payment was made late and it wasn't actually missed, that status 1 on that mortgage account doesn't exist as far as we're concerned. So it can be the difference between getting the tier that you wanted or getting mortgage lending full stop. So any of those late but not missed mortgage payment scenarios, come and talk to me about them. As far as unsecured, fixed and revolving credit is concerned, the flexibility that we can show around arrears activity will depend on the balance of the account in question. So any unsecured credit with a balance of no more than £500, we effectively ignore the arrears history and the arrears conduct. If you've got a balance of more than £500, if you want to qualify for the best products, we're happy with status 1s within the last 12 months, which is still really quite flexible. If you found yourself a little bit further down the credit curve and you're in a formal debt management plan, we don't have specifically designed, scarily priced products for customers in debt management plans. If you're in a DMP currently, you'll qualify for one of our standard products. You'll qualify for near prime. It's our bottom product here, but it's still a standard non-specialist DMP product. We need you to be paying the DMP off as part of coming to us, but we will capital raise for further debt consolidation if required. And those two needs do come as an intertwined part of people being in a DMP at the moment. If you're out of a DMP for at least 2 years, you'll qualify for our middle product here, which is prime. With a lot of lenders, to get anything decent, you've got to be out of your DMP for at least 3 years. Our maximum individual loan is 1.5 million, which is an improvement. We changed that at the opening part of this year. So anything credit related. If you want to send me credit files, more than happy to review them. Whatever your customer's situation is in terms of problems on their credit file, whatever the credit profile problem they've got, we've probably got a solution for it. We've got more appetite, more flexibility, a bigger reasons to lend mentality and operation, and our rates are as good as you're going to get in the specialist space. The second specialism is the one that I think, as I talked about at the start of the session, is the one that I think does make us really quite, unique in the specialist space. And that's where we're trying to sort of push the envelope around affordability. If you want those bigger LTIs or those bigger multiples, you're probably going to the high street, Santander, Nationwide, Halifax, HSBC, Barclays, Premier. Those are the lenders that if you want 5 times or more as an LTI, those are the lenders to go to. And the reasons why they can do that is because they want the squeaky clean lending. We specialist lenders are here to do the sort of lending that those lenders can't or don't want to do, either because of a credit profile issue, as I've just discussed, or maybe because of another specialist need that those lenders can't handle. So as an example of that, being able to use an increased latest year's income for a self-employed person instead of doing an average. The trade-off for us specialist lenders being able to do that sort of lending is that our approach to overall affordability and LTIs is a little bit more conservative. And generally, the maximum LTI you'll get in the specialist space is circa 4.5 times. There are 1 or 2 lenders around and about us that claim to do bigger multiples, 5 times, maybe slightly more. Lenders like Bluestone, Vida, TML. But it's all very underwriter discretion driven. So you don't know what the parameters are on a daily basis. So we're trying to give a little bit of a win-win scenario in as much as we want to be able to do the sort of lending that those high street lenders that you get your bigger multiples from won't do. But we don't want to have that give with one hand and take away with the other situation where we solve that problem for you, but then we kind of give you bad news in as much as we can't do the sort of multiples that those lenders can. We can do 5 times pretty easily, no special criteria applies. But if you take advantage of our flex option, which exists on our top 2 product tiers, Prime Plus and Prime, there's a £50,000 minimum income requirement on the application. But if it works on our affordability model, there's no limit to the LTI that we'll do. So it could be 5.5, it could be 6, it could be more than that. It really is as simple as that. If it works on our affordability model and you can satisfy that £50,000 income on the application requirement, there's no limit to the LTI that we'll do. And we've just extended that the flex option to first-time buyers, which makes total sense to me, because who's most likely to need a bit of help on affordability? It's first-time buyers, right? I think the reason we can do this is because our affordability model is maybe a little bit more sophisticated than the standard income versus expenditure models that you see out in the marketplace. We work on kind of 3 core metrics. Household composition, so the composition of the household that the applicant lives in, ONS data for their demographic, and their net income position. We'll stress the affordability if they're taking anything but a longer term fixed rate, so a 5-year fixed rate. But it really is as simple as that. There's no limit to the LTI that we'll do as long as it works on our affordability model and you can satisfy that minimum income requirement of 50,000. It's really important to point out that one thing that we won't do as a lender is use your customers' bank statements and the content of them as a stick to beat them with. Those lenders out there that talk about being able to do bigger multiples than 5 times, but it's all underwriter discretion, one of the classic mechanisms they'll use once the application's in as a fully submitted case, one of the mechanisms they'll use to change the goalposts around the affordability they promised to do at dip stage versus the affordability and the LTI they're willing to do now the case is in, is your customers' bank statements. We don't ask for full personal bank statements. We want 2 months personal bank statements, but we're happy if you filter them down to showing just salary credits. We don't need to see the rest. Brokers like that because if nothing else, it's one less barrier to lending. The ways that we consolidate our approach to affordability is that we're one of the few lenders that can take up to 100% of your non-guaranteed but regular additions to your basic salary. So classically, overtime, commission, bonus. The calculation that we use is the lower of the year-to-date figure on the latest payslip or the latest P60. We can do latest year's income for the self-employed, and I know there's a small handful of lenders in the specialist space that do that as well, but we're less labour intensive on it, and I'll talk about what that looks like in a second. Adult children that live with you, that work and are financially independent, we can factor them out of the household composition so they don't have an adverse effect on affordability. Our definition of financial independence is where they've got a job that gets them at least £600 worth of net income a month. If they can do that and you can evidence it, we'll factor them out of affordability. We do a term of up to 40 years on Resi, which is pretty unusual. And we can also go to 85 at the end of the term, which is also pretty unusual. We can even kind of be guided by earned income to do that. What does that look like? Well, it's dependent on the customer's age application and their pension status in terms of whether they've got a pension that's being contributed to them. So we assume a 70-year retirement age for your customer. If you tell us that they want to work beyond that and you want us to use their earned income beyond the age of 70, as long as they're no more than 59 at the point of applying to us and we can see that there's a pension being contributed to, we'll basically consider that as their repayment strategy in retirement, and we can go beyond age 70 using their earned income, and we can go up to age 85 at the end of the term. If they're 60 or older at the point of applying to us, we generally go up to age 70 and we'll use the lower of what their current income is, earned income is, versus their projected pension income. But if you tell us again that they've got the sort of job that can carry on beyond 70 and you want us to use their earned income beyond that age, we'll just do a little bit of a plausibility check in relation to making sure the job they do is one that they can carry on doing past 70. And if that's the case, we'll happily use their earned income beyond 70. One thing that we're good at is not going down that binary route of is the job manual, is the job not manual? Because we try not to make assumptions based on the applicant's job title, because some jobs, like an aircraft engineer, sound manual, but when you look into it and you have a proper conversation with the broker, it might turn out that the person is a consultant aircraft engineer and just sends diagnostic information and the parts required from the office they're based at to the actual engineers in the aircraft hangar. So that's the beauty of dedicated case management. You can have that conversation, whereas with lenders that don't have dedicated case management and underwriters just kind of hidden in the background, you don't get to have that conversation, and that assumption around the job title is made. So we're really pretty flexible around maximum term, maximum age at the end of the term. If you're employed, we want you to be in your current job for at least 3 months and out of probation. We don't have an overarching minimum employment history period that we need you to satisfy. You could have been out of work for 2 years. As long as you're in your current job for at least 3 months and out of probation, we will lend. We will also not dig our heels in on that 3 months requirement if you can demonstrate continuity of employment type. So if you've been working for Tesco's for 5 years doing a particular job role, and a month ago you moved to Sainsbury's doing that same job role and you're still in probation, what's the chance of you not passing probation? Pretty slim. A lot of other lenders out there will dig their heels in on that 3 months. We'll look to lend based on that continuity of employment type. We can take, as a standard thing, up to 50% of a second job, as long as you've had that second job for at least 12 months. And we can maybe even go beyond 50% by referral. Court-ordered maintenance from an ex-partner we can use. We can also use the net position on income you're getting from background buy-to-lets. We're pretty good with contract income generally, fixed term, day rate, 0 hour. Benefits are, we're okay with benefits, I think, because the ones that we kind of advertise that we're okay with are the true work and child-related ones. So child benefit, working family tax credit, child tax credit, and there's a maximum age of 12 on application for the oldest child, but that's a fairly industry standard thing. If you've got another form of income, we don't like investment income really, but if you've got another form of income that you can prove longevity of receipt on, particularly if the receipt of that income is benign, we'll think of a reason to try and use it. So if you've got anything like that, have a chat with me about it. But we're pretty good around those kind of complex multi-income situations where you also need those bigger multiples. I'm not saying come to us if you've got a case that you can get over the line with a Barclays Premier or a Santander, because as you know, competitive as our rates are in the specialist space, we can't compete with those high street lenders. But if there's something about the case that stops it from going to that lender that offers you the bigger multiples, a credit profile issue or another specialist need like latest year's income for the self-employed, that's where we come into our own. We're okay with 1 year trading for the self-employed, not on all of our products, but we can do it on prime. Dividends for non-controlling directors we can take. A lot of lenders won't like that because they'll say, look, you're a non-controlling director, so by definition, you can't control the dividends you get. We're not comfortable taking it. We adopt the same approach as we do with things like overtime and commission. If you can prove consistency of receipt, we'll use it. We never ask for accounts for the self-employed. Whether you're a sole trader or the controlling director of a limited company, the way we evidence your income is always via SA 302s and the corresponding tax year overviews. We use net profit if you're a sole trader, and most commonly we use director's salary and dividends if you're a controlling director, but we can also on a case-by-case basis look at situations where the customer wants to use net profit and salary instead of salary and dividends. If you're a self-employed person where your income has increased in the latest year and you want a lender that's going to focus their affordability on that latest year, we can do that. If the income increase is more than 20%, we'll basically need from you a rationale around how and why that increase in income is sustainable. But unlike a lot of lenders around us, that's where we stop. So that's what I was talking about a few minutes ago about how we're less labour intensive as a lender when looking at latest year's income for the self-employed scenarios. As long as that rationale that you give us around how and why that's sustainable makes sense, we're generally quite happy. We don't ask for business bank statements as a standard thing for the self-employed. So a bit like we don't ask for full personal bank statements, we don't ask for business bank statements for the self-employed either. And we won't need you to provide a projection to back up that rationale around the increase in income. You can provide one, but we won't ask for it. The third and last specialism is where we do the stuff as a specialist lender that high street and other credit scoring lenders just won't do. So things like pure interest only, we can do that up to 75% LTV. We stress interest only on an interest only basis, which you think would be an obvious thing to say, but it's not. Most lenders stress it on capital and interest repayment. And we want 150 grand's worth of equity. We accept downsizing, sale of subject property, that sort of stuff, but we need 150 grand's worth of equity. And we don't inflate that like a lot of lenders do for London and South East located property. We'll accept capital raising for most purposes, and I mentioned tax bills and businesses purposes there because the vast majority of lenders don't like those. We can do applications in sole name from married applicants. A lot of lenders in the specialist space will insist on married applicants applying jointly in all situations. We'll accept an application in sole name, and we'll also factor your partner out, the person that's not going on the application. We'll factor them out of affordability, a bit like we can with your adult children if they're financially independent as well. If you own your ex-marital home as a result of a divorce or a separation, we don't set a minimum ownership period to be able to remortgage. We don't need to see the deed of separation, and we don't need separate independent legal advice either. Gifted deposits from most immediate relatives are acceptable. We need a gifted deposit letter, and we're okay if that money's coming from abroad. As long as it's not coming from a sanctioned country and it's in the applicant's UK bank account, we're pretty happy. One of the benefits that I feel I have over lenders that I've worked for in the specialist space before is an internal valuers team. So instead of going down that subject to valuers comments route all the time, what we've got is the ability, when you've got a situation where your customer's property, the one they're remortgaging or the one they're buying, is one that maybe lenders would generally shy away from, have a chat with us about it. Whether we're talking high-rise ex-public sector, those with open deck or balcony access, flats above commercial, studio flats or houses on annex, come and have a chat with me about it, because we'll have a look at it, we'll look at what it is and where it is, and I'll have a chat with one of the internal valuers, because they're most likely to be the ones that will know what sort of feedback the actual valuer will come back with. And with a bit of luck, we can give a little bit of a provisional thumbs up on that property to give a little bit of confidence that your customer's not spending that valuation fee unnecessarily. If your customer's got a background buy-to-let portfolio and you want us to consider it self-financing and out of the equation, we operate a sort of pure self-financing approach to that. As long as the cumulative total rent per month that you'll get in exceeds the total cumulative mortgage payments being made on the portfolio, we're happy. No additional stressing is required. I've left them till last, even though they're the third and fourth bullet point on there, because they are very interlinked. We are real specialists in debt consolidation. When you think about the fact that we've got more acceptable capital raising reasons than other lenders in the form of tax bills and business purposes, a big portion of the remortgages that we get on a daily basis are for debt consolidation. The reasons why people like us is because we go to 90%, which is very unusual, not just in the specialist space, but outside of it. We also don't factor the debt back into affordability again. We also don't set a real sort of pounds value limit to the debt we can consolidate, because we don't have those restrictive debt to income ratios stopping us going above certain levels. As long as it works on affordability and sits within 90%, it could be £10,000 or £110,000 worth of debt. We're good to go. The not factoring the debt back into affordability again is a massive one. We pay the debt off for the customer. We don't give them the money at completion and hope they'll pay it off. The lenders that do, the safety valve that they factor into the equation is they refactor the debt back into affordability again. Paying it off for the customer, the positive byproduct of that is that we know for a fact it's gone. And we also, unlike a lot of lenders, we won't pay, or we won't charge your customer per account that we're paying off. We have one telegraphic transfer fee of 35 quid. That covers all of the external payments that we need to make. So it's a real saving compared to other lenders. Our fast track in-house legal service on remortgages up to 750 quid is also worth its weight in gold. I've worked in the specialist space for 2 previous lenders for 15 years, and I've not seen anything quite like it. It's our own firm of solicitors, which means they work for us exclusively. The benefit of that is that your customer's case doesn't land on the same conveyor belt of business they're doing for other lenders. They're based at our head office on the same floor as the case owners and underwriters. The benefit of that is that communication between lender and lawyer is brilliant, where normally it's okay at best. And crucially, we instruct them at application submission stage, not offer. The benefit of that is that by the time the case offers, 95% of the legal work is done, which means that there's a really small window between offer and completion. As an average, since we launched, it's like 11, 12 days. It's really, really short. And that is massively beneficial to people that in particular are debt consolidating, because it means that long-standing debt that they've been stressing over the long period is gone so much more quickly. And invariably, our cashback products that give 500 quid cash back, they're most often used in debt consolidation situations, because you can use the £500 contribution we give you to pay a big chunk of the legal fees, because it's not a free service, but that's okay. Because if it was free, it wouldn't be very good, just like all free legals. That's not an exhaustive list of stuff we do on the specialist side, but it's just an idea of the stuff that we can do. So the stuff that we do for your customers, what does it kind of look like in the cold light of day? These are a couple of recent case studies that we've put together. The first one, they kind of showcase lots of things about the lending criteria, kind of unique selling points that we've got. But these ones are quite kind of like maximum age at the end of the term, the LTIs that we can do, and does sort of showcase things like the fast track legal service. The first one is basically someone coming from another specialist lender, reverting to SVR, which was quite high, and they've only got 1 year's accounts. So they were being offered an SVR of like 8.5% with their current lender. They've only got 1 year accounts. It was an LTI of just over 4.5 times. They qualified for our prime product tier, which is where we start as far as 1 year trading is concerned. They did go for the fast track legal service, and it took just 8 days from offer to complete. And we paid off all of the debt via that one telegraphic transfer payment. The second case has got a bit of everything, really. It's a remortgage case for an applicant switching from or wanted to switch from interest only to repayment. She needed to debt consolidate as well. And because she was an older applicant, in inverted commas, she wanted a lender that will go to the oldest age and do the biggest term for her. She's a teacher, 54 at the minute, on interest only. Her fixed rate had expired, and her current lender was saying, look, SVR is the only option for you. We're not going to offer you another product. She wanted to consolidate debt and switch to repayment. She wanted an end date to that mortgage, but it was failing on affordability and debt to income ratios quite badly elsewhere. But because of her job, she's got a pension that she's paying into. So because she's less than 59, she qualified for Prime Plus Flex, which meant that 5.8 times LTI that she wanted was doable because it worked on affordability. And we also, because of her age, were able to use her earned income because she's paying into a pension. And we did that 31-year term that she wanted to age 85. So we consolidated all of her debt. We switched her from interest only to repayment. And she used the fast track legals as well. And the case took just 22 days from submission to completion. So there was a big saving for her there. She's paying almost identical what she was paying to her interest-only mortgage for the previous lender and all of her debt combined. And we're doing it now on repayment with the debt consolidated. She was absolutely over the moon. And it's a case study that was posted on LinkedIn by our marketing team pretty recently. Just some ideas around in real life what our business looks like. If you've got something that falls outside of lending criteria, come and talk to me, because in a landscape where specialist lenders in particular don't want to do exceptions to lending policy for new business, we try and adopt a reasons to lend mentality to most scenarios. So if you've got something that falls between the lines of lending criteria, if there's more reasons to lend than there are not, we've got a starting point. So come and have a chat with me. Those are my contact details. Put them in your phone. Reach out to me after the session. I'm not sure if we've got any questions. Do we have any questions? Don't think we have. That's okay. That hopefully means I've done my job properly. One of the most common things I get asked is about things like service timescales. How quick are we? Because in the specialist space, speed isn't what we lenders are known for. We're pretty quick. We're only just over a year old, so we're sort of fine-tuning the case management system, the dedicated case management system. So, work with us on it. The one thing that I'll give you as a bit of free advice: when you have that first underwrite done by your case owner and they give you that updated checklist of processing sort of documents that we need to get the case to offer, upload them in one go as soon after you get that checklist as you can, because then the case manager's reviewing them all in one go, and anything extra they'll need, they'll ask for it in one go. Provide those in one go, and then you've got valuation instructed. And what you've then got is a case that's ready to be offered subject to the valuation report coming back with the results on it that we're all keeping our kind of, fingers crossed for. If there's no further questions, thank you, everybody. I hope you've enjoyed the session. I hope it's been useful. Please feel free to reach out to me separately with any potential cases that you've got. I hope the week's been kind to you, and I hope the weekend's kinder.